Good afternoon and welcome to the webinar hosted by the Investor Responsibility Research Center Institute and the Investment Integration Project on a new research report, Tipping Points 2016, Summary of 50 Asset Owners and Managers' Approaches to Investing in Global Systems. The logistics for our webinar today are as follows. All attendees are in listen-only mode, but we are interested in your questions. If you have a question during the presentation, just type it into the question box on your control panel. Following the presentation by the report authors and John, we will respond to those questions. Our session today is being recorded, and a replay of the session will be posted later today on www.IRRC Institute and our YouTube channel, which you can link to from the IRRC website. If you're interested in sharing information about this webinar and report, we encourage you to do so. Our Twitter handles are @IRRC Research and @tip_insights. If you have any audio or other issues during the webinar, please call GoToWebinar at 1-800-263-6317. We have three speakers today. The first is Steve Leidenberg, followed by Steve will be John Lekumnik, and then William Burkert. Steve is the founder and CEO of the Investment Integration Project and also a partner with Domini Social Investments. He's a recognized leader in the areas of social and environmental performance of corporation and has been working in the field since 1975. He's the founding director of the Initiative for Responsible Investment and has been published widely on responsible investment topics over the years. He's the co-author of the study that we're discussing today. Our second speaker, John Lekumnik, has served as executive director of the IRRC Institute since its founding. With the board of directors, he's led the organization to become a leading source of objective academic and practitioner research on an array of investment issues. He has decades of experience as an institutional investor, including time as the investment advisor to the New York City Pension Fund. John also is the author of the new book, What They Do With Your Money, How the Financial System Fails Us and How to Fix It, published by Yale University Press. And our third speaker is William Burkart. Bill is the president and COO of TIP. He also is the founder of Burkart Consulting, an impact investing advisory firm. Bill has been at the forefront of impact investing and has contributed to the field through groundbreaking research, including leading a multi-year field building effort focused on the financial services industry in collaboration with the Money Management Institute. Bill's a visiting scholar at the U.S. Federal Reserve, serves on the Global Advisory Council of Cornerstone Capital Group, and is a co-founder of Impact Economy. Bill, too, is a co-author of the study we're reviewing today. Just a couple words about the IRRC Institute. It's a nonprofit established in 2005, and essentially what the Institute does is it funds and disseminates objective, unbiased research on a wide range of issues at the intersection of corporate responsibility and the informational needs of investors. So everything from environmental, social, and governance issues that we're talking about today to executive compensation, just a wide range of different issues. And it's, again, focused on that both academic and practitioner research. We also have an annual research award, and we are in the process of reviewing those research applications and watch for news about who the winners of those research awards are coming next month. There's more than 40 research reports available at no charge, and we encourage you to go to the website and take a look at what else is available. With that, I will turn the presentation over to Steve for some words about TIP and to also start diving into the research findings. Steve?
Thank you. So today we'll be talking about a state of the industry report by TIP on developments among institutional investors who have launched on a road to thinking about their impacts of their investments on environmental, social, and financial systems. I'm going to start with a few brief words about TIP itself, then turn it over to John for some thoughts from IRRC Institute on the context of this report, and then Bill and I will provide some highlights on the report. Next slide. TIP was founded in, I'm sorry, go back one slide, I'm sorry. TIP was founded in 2015 to provide resources for institutional investors who are wishing to understand the relationship with these larger environmental, social, and financial systems. As the world becomes more complex and finance grows in size, the influence of that relationship between investors and these systems is becoming more important. For example, in finance, today's investments in energy will influence the climate tomorrow, and that climate will in turn impact investments. And similarly, we saw in 2008 in the financial crisis that investments in various financial products and services influenced the stability of the overall financial system, which in turn hurt all portfolios. So these connections are increasingly being recognized by the Principles for Responsible Investment, the International Corporate Governance Network series, and others. And TIP is working to collaborate and catalyze with others research in this area. Next slide. So one of the interesting things about the awareness of the importance of these systems is that it is developing along two separate tracks. On the one hand, you have investors paying attention to the impact of environment and social issues at the portfolio level. Integration of ESG, PRI signatories are all committed to that. Impact at a portfolio level, the Global Impact Investment Rating System measures that. And that is very good work being done at that level. And similarly, at a systems level, there is excellent work being done in measuring the health of society, the progress of accounting for natural capital, the stability of our financial system. But there exists a gap between these two worlds. They're operating somewhat parallel, and TIP is hoping to provide the kind of tools that helps investors bridge that gap between the portfolio and the systems level work that's being done. So next slide. We're doing that in a variety of different ways through reports such as this one, through development of resources and tools that could be used by institutional investors who are thinking of implementing programs that bridge this gap, and through convenings of asset owners and asset managers, bringing them together to talk about these issues. And we have a research program which will be continuing work in this area. Our overall goal here is to foster dialogue, to facilitate debate and progress in this area. So that's a general background on TIP. And before we get to the details of the report, let me turn it over to John for some general thought on context of this report.
Thank you, Steve. Those of you who know me know that my intellectual orientation is as an institutional investor. And I am really, really excited about this report. It's not going to get screaming news headlines, but it is potentially one of the more important reports that we've done, because I think that it redefines an investing paradigm. That is an overused word, but when we get done, you'll make your own decision as to whether or not that's true. Systems level thinking, as described in this report, is the next great evolution for investors on how to deal with risk. Let me try and put this into some sort of historical context. Before 1952, those of you who are academics in this area will recognize that was the date of Harry Markowitz's Modern Portfolio Theory paper. Investors dealt with risk in a very simple way. They didn't buy anything risky. Institutional investors, particularly those who were fiduciaries, shied away from risky assets. They bought bonds. This was, for instance, why many state pension funds didn't have a prudent person guideline for how they should invest, but legal lists where literally the state legislature would say you're allowed to buy this much of this and that much of that and that much of that security. And that wasn't that long ago. In fact, a number of states, including my own, New York State, still have legal lists where the idea is that you control risk by controlling how many risky assets you buy. Now that, in fact, did deal with risk on a security by security basis, but it didn't deal with risk on a portfolio basis. And the result was that portfolios were low returning, largely bond, and somewhat under-risked, which meant that institutional investors were not a large part of the capital markets at that time. Next slide. In 1952, Harry Markowitz introduced modern portfolio theory, for which he later won a Nobel Prize. And MPT, as most of the people on the call know, encourages investors to buy riskier assets. Why? Because he understood the power of diversification. You can diversify the idiosyncratic risk of a security by thinking about it at a portfolio. It's okay to have riskier asset A and riskier asset B as long as A and B don't move together. In other words, if some return patterns zig while others zag, the volatility gets smoothed out over time. In modern portfolio theory, it's really basic. That's correlation, and you don't want things that correlate. So investors could now deal with risk at both the security level, don't buy anything risky or choose your risk level, and at the portfolio level. The issue, though, was that systemic risk, what Markowitz called market beta, was viewed as exogenous to investing. It was beyond the ability of investors to affect. The issue there, ironically, is that beta, the systemic risk that you were exposed to, explained more than 90% of your variation in return, not your security selection, not even your portfolio construction. And so one of the major drivers of your return for Markowitz and for MPT generally is exogenous. You can't do anything about it. You just accept it and you move on. Next slide, please. What this report says and what TIP's philosophy is that all portfolio investment affects and is affected by systemic risk. They define systemic risk in three ways: environmental risk, social risk, and financial risk. In effect, that recognizes what we've all known intuitively. Your investments are affected by systemic risk. You can see it just in fund flows, for instance. The popular phrase for the last few years has been a risk-on, risk-off market. Well, what does that mean? It means that a number of investors are choosing riskier assets, and therefore asset prices and multiples expand, or they're fleeing from that, and therefore multiples decrease. So in effect, the action of all investors is changing the market beta. It's not exogenous. It's the result of our fund flows, of how we as a whole choose to invest. Now, there's also the ability for single investors or groups of investors to change market betas. And sometimes they do it with what the TIP report calls intentionality, the deliberate design to change the market beta. So, for example, more than a decade ago, CalPERS looked at the laws and regulations protecting external equity investors in the Philippines and said, we don't like this. We're withdrawing from the Philippines. And the market in the Philippines declined. The Philippines government recognized this was a problem, made a number of pilgrimages to Sacramento, changed their laws. CalPERS reinvested, others followed their lead. In other words, CalPERS affected the market beta of the entire Philippine equity market. Similarly, groups of investors, in the case of proxy access, led by the New York City Comptroller's Office, have changed what the governance structure of the U.S. equity market is around majority voting and proxy access. You could call that beta activism, if you will. Things which are intentionally designed to change the overall market structure, risk, and return. So this isn't what we think of as activist investors, which take place at a company, but beta activism, again, designed to change the overall beta of the market, something that Markowitz never considered. Next slide, please. So the question is, why has TIP been able to recognize what Markowitz missed? I mean, Harry Markowitz is a really smart guy. I call it the gravity conundrum. Right? I personally have a gravitational effect on the moon. Scientific fact, provable, but really hard to discern, and somewhat irrelevant since it's so hard to discern. Well, the capital markets have changed since Harry Markowitz's time. In 1952, about 8% of the U.S. equity market was held by institutions. Today, it's more than 70%. So obviously, institutional investors, large ones, whether it's for-profit entities like BlackRock or mutualized entities like Vanguard, or asset owners like CalSTRS or New York State or Norges Bank or PPPM or whomever, can affect both individual companies, we know that from the activism and the engagement studies that are done, and markets overall. To be fair, I said that I thought that this was a really historic conceptualization of a change in how institutional investors act and think. I think it is hard to tell if you're witnessing a paradigm shift when you're in the middle of it. I think we are. Perhaps I'll be proven wrong. But I do think that systems level thinking has the potential to be a fundamental change in how institutional investors conceptualize our investments and their effect on the systems, and how we think about systems' effect on our investments. In effect, it means that things are not that exogenous, that you can try to affect beta, which is much more powerful than trying to trade your way to some sort of alpha or outperformance of the overall market risk and return profile. And with that, I'll turn it back to Steve to start diving into the report.
Great, thank you, John. And so let's turn our attention to the report and see, in terms of this report, how we see institutional investors bridging this gap between their investments at a portfolio level and their concerns about what is happening at these larger systems level. This report was released a week ago Monday. It's available on the TIP website as well as on the IRRC Institute's website. And in it, we are attempting to portray how far things have come in terms of this thinking and how far they still have to go. It provides both an overview of our findings from looking at these 50 asset owners and asset managers who are profiled in the report, as well as specific profiles, 3 to 5 page profiles of each one of the investors. I'm going to go through, Bill and I will go through the basic overview of the findings from the report, and hope to leave time for Q&A at the end. Next slide. Oh, here, no, that's fine. So the study, as I said, examines 50 asset owners and 50 asset managers. It has 3 main findings, that is, in this attempt to get from portfolios up to systems level, or bridge that gap. We talk about what we call key investment activities. These are traditional investment activities that can be built upon in order to expand the horizon of one's activities to include the systems level. We also talk about 6 on-ramps, which are general approaches that allow you to develop language that can incorporate and capture systems level considerations. And then, in one of the things that we view as one of the more important and groundbreaking aspects of the report, we talk about what we call 10 tools of intentionality. So intentionally, how do you get up to that systems level? Next slide. So our methodology in this was fairly straightforward. We wanted a diverse set of asset owners and asset managers in order to get an overview of what's happening in the field. We wanted diversity in terms of size. We wanted diversity in terms of approach. We wanted diversity in terms of geographic location. We also wanted to examine institutional investors that were already active in this area, that we had some reason to believe, by reputation or familiarity of one sort or another, that we're already doing something in this area. And we worked with both a combination of public documents that they already were speaking about their activities in these areas, along with a survey sent to these asset owners, and provided an opportunity for feedback on our profiles to them. And we recognized as we were doing this that our vocabulary of systems level may have been somewhat unfamiliar to them, so we made every effort to communicate how we were looking at when we used systems level coincided with what they were doing. So next slide is a list of the asset owners and asset managers that we surveyed. As you will see in the asset owners side, we attempted to get, even within the realm of asset owners, a variety of asset owners, not just the large public pension funds, but also sovereign wealth funds, insurance companies, endowments, and even development financial institutions, which clearly have a social and environmental concern and a kind of system level approach. And then on the asset manager side, we wanted to make sure we captured not only the large diversified financial institutions or specialists in particular asset classes, but as well as those asset managers who had been self-identified and working in the area of responsible and impact investing. The point of this diversity is to get the broadest possible scope of what's going on in the field. Next slide. Let's turn now to the key findings. There are three of them, as I mentioned before. First relates to what we call key investment activities. I will discuss the finding in this area and then turn it over to Bill to talk about our second and third main finding. Our main finding here is that there are a number of traditional investment activities that all investors engage in and can build on when they are looking to the systems level. Next slide. So these are the 5 key investment activities that we view all investors look at in one kind of way or another, and can be used to make a transition, expand the horizon to include systems level issues relatively easily. That is to say, investors are on familiar grounds when they are looking in these areas. And I'm going to go through each one of these, provide a little bit of background on what we mean by each one of these activities, and then an example of how we can go from a portfolio up to systems level in each one of these areas. So next slide. First of these is investment belief statements. Virtually every asset owner, institutional investor has an investment policy statement, and many are now expanding those to include specific beliefs about the nature of the markets. So a typical investment belief statement would talk about diversification and its virtues, talk about the relationship, the belief of the investor, about the relationship between risk and reward, talk about the belief of the investor about the efficiency of the market. Is it efficient in the short term, long term, in a strong form, a weak form, that kind of market belief. This kind of statement, however, also provides an opportunity for investors to talk about social and environmental issues, both in relationship to their portfolios and in relationship to their connection as investors to larger environmental and social and financial systems. So an investor belief statement could include examples such as ESG factors are helpful in individual security valuation, or they add long-term value to a portfolio. But they could go even further. They could say that these ESG considerations are a source of investment returns, that they are a systematically important resource. And that is what CalPERS has done in its investment belief statement, which covers a whole variety of issues, but they are important. They are clear to include a statement that there are what they call two physical capitals, human capitals, and financial capitals, which are a source of investment returns, and therefore are a systematically valuable, a part of the system that is valuable to all investors. Next slide. So security selection, obviously all investors select securities. and all investors are relatively clear about what their philosophy is about security selection. Are they active investors or are they passive investors? Are they growth investors or value? Are they quantitative or qualitative investors? Do they have do they require certain buy-sell disciplines? If they're money manager, they have certain buy-sell disciplines. So it is possible to go from that kind of philosophy of security selection to the integration of ESG factors as a risk consideration when it has to do with individual securities. But it's also possible to go from there to look at ESG factors as more systemic when it comes to security selection. How do they relate to all assets across the portfolios, all asset classes, all assets within individual portfolios? And we see this kind of more comprehensive view of environmental issues playing itself out in the indexes relating to climate change. We have the example here I'm giving is the Low Carbon Index, and it's been established by the New York State Common Fund. A similar index and philosophy was recently adopted by Cal STRS. Both have allocated a couple $2 billion from their funds to these. And these look both to the portfolio and to the larger system in the sense that they make an assertion about portfolio risk, of the whole portfolio on the, in this case in equities, the whole equity portfolio, but also they send a message to the market. They say that this is something that is taking this portfolio level approach. They say that this is an issue that is systemic in nature and has systemic implications for investment. Next slide. Engagement is an activity that all investors certainly have the opportunity to do. They can engage at a single security level, communicating with management on their philosophy on how well a company is run. This is essentially engagement that's done on a financial basis. The most extreme example of that is the activist hedge funds these days, which even seek to take board positions and advocate such things as the breakup of a company. So that's done primarily with an eye to the portfolio and the financial performance of the portfolio. Increasingly, investors are engaging on ESG issues with an eye both to improving individual performance, that is to say, a particular company that may feel that is an environmental policy of the program, a social policy of the program, human rights, diversity, etc., is hurting the company overall, and they wanted to improve on those policies in order to get better performance for the company, stock performance. But other investors are going beyond that. They extend their engagement to changing basically the rules of the game. This can be done through engaging in changing industry standards, the rules of the game on the environmental standards, the human rights standards, the social standards of how industries set their practices. And even more broadly than that, they can be engaging on a level of public policy to set a level playing field in society as a whole. And Aviva, the British insurance company, is an example of that. It has been a very strong advocate of market reforms to set a level playing field for a sustainable financial market through government policies and practices. Not only that, Aviva also has advocated for stock exchanges to require disclosure of ESG data and other public policy issues. So engagement here can also be taken up to a systems level. And next slide. Another avenue that most investors certainly have available to them and avail themselves of typically is what I would call targeted investing, such as targeting certain regions, emerging markets, for example. or developed markets. You, for one reason or another, financial reason, you diversify across markets and set certain goals for your targeted markets. There's also targeted markets in the sense of sector funds. So certain sectors of the economy, as an investor, you want to target because there's a financial reason, an asset allocation reason, and a technology play, what have you, that leads you to invest in certain sectors of the market. This technique then can be applied to environmental, social, and systemic level issues. Some investors, either by choice or by mandate even, focus on particular regions in which to invest. And that region, investing in that region is a form of targeted investment with a goal of economic development. And some investors, such as the Caisse de dépôt in Quebec, has taken a particularly systemic view as it invests in the Quebec region, which it is mandated to by the legislation that created it. And it has looked at the interrelationship of its investments within Quebec. So, for example, it invests both in public transportation, access to the airport from downtown, and downtown facilities, hotels, office buildings, etc., as a way of promoting economic development in that region. So targeted investment also can be done in such a way with a system, whether it's a confined local system or the similar can be done in issue areas to get up to the systems level. And finally, next slide, manager selection. Everybody engages, all asset owners in any case engage in manager selection. They have certain styles they are looking for. They monitor their investor managers to make sure there's no style drift. They look to the performance. Is the performance they're getting what might be expected from that style? And ESG certainly can be very easily integrated into a manager selection process as a enhancement to the performance of the managers, but it can also be used to send a message to managers that as an investor, there is a broad level of concern on the part of the manager, of the asset owner, and that broad level of concern needs to be understood and implemented at the manager level. So one example of that is ERAP, which is the French supplementary pension scheme, national pension scheme, and that is 100% SRI and has taken a very broad view of the value of responsible investment and has, as part of its manager selection process, the requirement that the managers also understand what ERAP is, the direction ERAP is headed. So these are 5 ways in which traditional aspects of money management can translate relatively easily into systemic level considerations. Next slide. So the main takeaway from that is that is one avenue in which one can get from portfolio level concerns up to the systems level. And I'm now going to turn it over to Bill to walk you through the 2 other ways we think about how this translation is made from portfolio to systems level, one through what we call on-ramps and the other through what we call intentionality. So at this point, I'm going to turn it over to Bill.
Great. Thanks, Steve, and thanks to John as well. So just go ahead and hit the next slide. So I'm going to dive right into the second major area of findings, which are these 6 on-ramps or approaches to systems level thinking. And just to kind of recap, the fundamental objective of this report that IRRC Institute, me and Steve, and our co-author Jessica Ziegler set out with was to really understand whether and to what extent institutional investors consider and manage their impacts on these systems level, and in turn consider those systems impacts on their portfolios. So throughout this process, we identified a range of these on-ramp approaches to systems level thinking. We interchangeably called them systems-related approaches. But the point is that these on-ramps have the potential to serve as avenues to the adoption of systems level approaches. And to make that metaphor really literal, we'll go to the next slide. And so what you see here are those 6 on-ramps. And so I'm going to quickly go through and just define them because some concepts might be more familiar to some and less familiar to others. So starting with on-ramp number 1, ESG integration, commonly characterized as the systematic and explicit integration of environmental, social, and governance factors into financial analysis. Within ESG incorporation, investment institutions complement traditional quantitative techniques of analyzing financial risk and return with qualitative and quantitative analysis of ESG policies, practices, performance, and impacts. The second on-ramp, long-term value creation, defined as potential to create long-term value based on sustainability criteria, sustained financial quality, and a demonstrated ability to manage both current and future economic and governance opportunities and risks by focusing on a long-term strategy. On-ramp number 3, the buzziest of all, impact investing, commonly characterized as investments made in companies, organizations, and funds with the intention, emphasis, intention, to generate social and environmental impact alongside a financial return. Impact investing focuses on both emerging and developed markets where it targets a range of returns from below market to market rate depending on various circumstances. Fourth on-ramp, universal ownership, defined as the ownership of securities in a broad cross-section of the economy, because universal owners diversify portfolios of stocks, bonds, and other asset classes. Investment returns, particularly the long-term ones, will be affected by the positive and negative externalities generated by the entities in the investment portfolios. The fifth on-ramp, investment stewardship, commonly characterized as aiming to protect and enhance the value of clients' assets by engaging with companies, encouraging business and management practices that support sustainable financial performance over the long term. This also applies to ESG considerations to all investment strategies, whether indexed or actively managed. In effect, investment stewardship adds an ownership discipline to an investor's buy and sell disciplines. The final on-ramp, negative exclusionary screening, which here includes reweighting, defined as the diminished investment or total exclusion from a fund or plan of certain sectors or companies based on specific ESG criteria. Negative screening encompasses an implicit assertion that by doing no harm, investors can create a better society. Next slide. And so this just gives us a glimpse at what the investors within the context of our study, who is doing what. And the kind of headline news is all investors that we studied are integrating at least one of these on-ramps. Frequently, they're doing several of these different approaches. If you look from left to right, you'll see that ESG integration is the most popular, with impact investment and negative exclusionary screening falling somewhere in the middle. And then at the very end, universal ownership being the least active strategy or the least familiar concept. A lot of the reasons behind all this are related to some of the methodological comments that Steve made at the outset. So we'll go to the next slide. So key takeaway here, the on-ramps represent a logical extension of the concept that investment has impact on the world at large, and that impact can be managed for investments to fulfill the proper function in society. This should, in turn, improve efficiency and reduce risk as those systems affect investment in the future. So this gets us to the next slide, which is the big one, the kind of major key finding we had, which was this breakthrough around the 10 tools of intentionality. These tools represent, just go back one. These tools represent specific pathways through which investors can bridge the gap between daily portfolio management decision-making and systems-level investing. Investors use these tools intentionally because the portfolio-level discipline of efficiency alone does not naturally lead them to do so. Next slide. And as you guys might recall, I emphasized the word intention when I read off the definition of impact investment earlier. And it's really, this is this kind of distinguishing feature of impact investment, but it increasingly is the distinguishing feature between just general systems related or on-ramp type investing versus systems level investing. So you can see the definition again. This comes from the Global Impact Investing Network. So we'll go ahead and go to the next slide. And so what we're seeing is this concept of intentionality manifesting itself within these various tools, these 10 tools. And it's really how these investors are manifesting their concerns and risks about risks and rewards at systems levels and facilitating impact in a variety of ways. So just staying on this for just a few seconds, let's start up maybe at the top towards the right, look at something like locality. This is the intentional pursuit of sound investments that support and strengthen interrelated economic activities within a defined geographic region. Going a little bit further, something like standard setting. This is intentionally declaring off-limits certain investments that transgress broadly accepted bounds of normative conduct, or conversely, to emphasize certain investments that support broadly agreed upon goals for positive norms. Going a little bit further around the circle, towards the bottom, you get to polity. This is intentionally engaging in public policy debates that investor views as relevant to their particular management of risks and rewards at systems levels. Going a little bit further, you have diversity of approach. This is the intention to accommodate the consideration of a diverse set of systems level issues. Going a little bit further, you get to interconnectedness, and this is intentionally investing to increase the flow of information about the environmental, societal, and financial systems that investors operate within, either among themselves or with the general public. So you see I cherry-picked a couple of those because the next slide, I'm going to go deep on a few that I didn't mention. So with the next, yeah, perfect, stay here. So with additionality, this is intentionally pursuing investments that address issues historically underserved by mainstream finance. These firms choose investments that strengthen often neglected elements of overarching systems, elements that add to these systems stock of resources, increase their complexity, and provide them with additional resilience. This means investing in improved opportunities for broad access to financial services, technology, healthcare, energy, for those who have been historically underserved. Examples that we highlight here include the Irish Strategic Investment Fund, which is a sovereign wealth fund, which makes additionality a criterion with investments in the Irish economy that don't create displacement or dead weight. Bridges Ventures, one of the kind of gold standard impact and responsible investment managers, makes investments in underserved regions or undercapitalized services and products that would otherwise be disregarded by the market. Next slide. We get to solutions. Solutions is the intentional decision by investors to create investment vehicles that target particular social and environmental problems or of substantial systemic importance. The example we highlight here is PGGM, the Dutch pension fund manager, which has allocated a multi-billion-dollar portion of its assets to what is described as a solutions portfolio that focuses on 4 issues: climate change, food, healthcare, and water. In this way, PGGM is intentionally creating investment vehicles that can achieve competitive returns while targeting particular social or environmental problems of substantial systems-related importance. One of the goals of a solutions-focused approach is to address challenges confronted by fundamental elements of social and environmental systems broadly conceived. Next slide. This takes us to self-organization, which is the intentional decision by investors to allocate resources to strengthening the resilience of the financial system as a whole. The profiles that we included in the report highlight 18 organizations that intentionally pursue this approach. The underlying rationale for these self-organizing activities is to build into the financial system the elements of resilience that allow it to interact effectively with environmental and social systems. Calvert and Dominy, long-standing responsible investment managers, have broken ground in research methodologies and standard setting. Nourish Bank and Nelson Capital, which is now part of Wells, promotes academic research. Jesse Smith Noyce and F.B. Heron Foundations focused on the investment role of foundations, and Hampshire College in the management of academic endowments. Obviously, we have more examples in the report, but that's just a sprinkling. Next one. Next slide. So finally, we'll wrap up with utility. Utility is the intentional decision by investors to maximize the alignment of the asset classes in which they invest with the societal purposes these asset classes were designed to address. So what the heck does that mean? Okay, so this means that investors assume that alignment with these purposes will create social and environmental value in addition to that of the portfolio. So for example, many fixed income investments are well designed for community economic development purposes, venture capital for creating disruptive advances in products and services, public equities for the efficient allocation of capital among competing socially useful large-scale enterprises, and real estate for the creation of a sustainable physical environment. Breckenridge is a leading example of a group that's doing this within the context of fixed income. Next slide. So key takeaways here. The 10 tools represent specific pathways through which investors can bridge the gap between daily portfolio management decision-making and systems-level investing. The second one is that investors use these tools intentionally because the portfolio-level discipline of efficiency alone does not naturally lead them to do so. Next slide. And so just to recap the kind of major key 3 overall takeaways, systems-level thinking is being integrated into traditional investment activities. Investors profiled in the study are using 6 key on-ramps to systems-level thinking. And the 10 tools of intentionality represent specific pathways through which investors can bridge the gap between daily portfolio management decision-making and systems-level investing. Final slide. So fundamentally, finance is going through yet another major evolution. And the implication of the 10 tools is that investors are increasingly managing to 2 goals simultaneously: positive social impacts and making money. On the one hand, investors buying and selling in the marketplace daily manage their portfolios on the basis of price, seeking to maximize their returns while minimizing their risks. At the same time, these investors, with an eye to the long-term preservation and enhancement of the frameworks within which they operate, are seeking to manage their impacts at the environmental, societal, and financial systems levels. By integrating both goals, they work to achieve a balance between doing good and making profits, between values and price, between reason and rationality. In doing so, they seek to enhance value at the systems level without contributing to its destruction. And that's it for me. I'll throw it back to John and Kelly.
Oh, thanks so much. We are now moving on to the Q&A portion of the webinar. So just as a reminder, if you have questions, I see several of you have questions. We've already got several in the queue. There's a question box on your control panel. Just type in your question. We'll read it aloud, and one of the speakers or several of them will answer your questions. There's a couple questions I can take first. Will this deck be available? The answer is yes. We will have it posted on the IRRC website by tomorrow morning. I'm sure it'll probably be on the TIP website also. I don't know if you have thoughts on that, Bill, but it will be available. Our next question: what is motivating the interest to integrate portfolios and systems? Is it about cost savings, risk mitigation, or the actual creation of value?
This is Steve. Let me take that question. And I think the answer is, I think, all of the above. That is to say, there are clear relationships to the portfolios of the systems on which investors are focusing particularly. So climate change is certainly an example of that, and I recommend the study by the University of Cambridge's Institute for Sustainability Leadership called Unhedgeable Risks in that regard. Simultaneously, though, I think people understand that there's a fundamental, I think there is an understanding creeping into the consciousness of investors that, in the words of the the Stockholm Resiliency Center, we no longer live on in a small world on a large planet, but we live in a big world on a small planet, and that if we want to live within the boundaries of what that world permits, they call these planetary boundaries, that we need to pay attention to those larger issues. So that's I think that that understanding is creeping in.
I would just
And if
add
I
to
could just
that. Yeah, sorry, go ahead, John.
go ahead, Bill.
I would just say, just from the actual report, what the data told us. So we looked at a couple of different dimensions, or at least a few dimensions were surfaced in terms of motivations for why investors are going this route. The kind of most popular motivation, or the one that was most prevalent, was risk reduction. And cascading down in order of least frequent was financial returns, non-financial returns, aligning investments with organizational beliefs. Asset owner demand or preference fell somewhere right in the middle. Towards the end, you get macro trends, stakeholder considerations, and then finally regulations. And that's kind of what the data told us.
And I'll just add the two events that I think have accelerated this. As I said, the institutionalization of assets can't be overlooked as a background factor. But I think the global financial crisis made a lot of financial investors wonder about the stability of the system that they had taken for granted previously. And then climate change, and particularly the Paris Accords, where major financial institutions were among the heaviest lobbyists for the Paris Accords, demonstrated to the financial institutions that they had the ability to affect things. So you had, in the one case, the risk, the fear, if you will, that said, wow, we're really subject to this, and what can we do to mitigate it? And then you had, in Paris, the recognition that they had the ability to do something about it, and in fact, were leading players in that situation.
Thank you. Our next question, this is all great. I feel like the idea of beta activism is only meaningful if we acknowledge that it requires leaving some alpha on the table, even if that simply is a matter of leaving free riding opportunities on the table. And it seems like the challenge that intentionality, and that seems like the challenge that intentionality represents. Do you have any thoughts on this?
Sure. Since I use that phrase, I'll take it. The free rider issue is relevant for the asset managers. It is not relevant for the beneficial owners, right? If you think about it, there's a cost to doing the beta activism, because and you disproportionately share the costs compared to your proportional share of the benefits. So, and that is the same for alpha activism as well. If you are an activist investor, for instance, everyone who owns that stock gets the benefit, assuming there is a benefit. But it is very positive for the commons. This is the opposite of the tragedy of the commons, right? This is the maintaining of the commons. And I think that what people have come to realize is there are ways to mitigate the cost. There are collective entities such as PRI, ICGN. There are ways to do this at a low cost. So, for instance, the low carbon index funds, which measure their costs in basis points that are really no different than other index fund costs. In terms of leaving alpha on the table, I'm always sort of amazed, right? The net alpha in the market is zero by definition, right? So if you can improve beta, it's a much safer bet than betting that you're smarter than all the other people in the market, plus overcoming the hurdle of your fees. So I think there is an increasing recognition that doing some beta activism, particularly if you are an asset owner with liabilities, such as a pension fund, those are some people who do most of it, is a winning strategy overall, as opposed to believing that you can out-trade the other people in the marketplace. So to summarize all that in two simple things. One, yes, there is a cost. People are trying to mitigate the cost through collective action or low-cost implementation of beta strategy. And B, I do reject the idea that if you don't do it, you could automatically add alpha, because alpha is actually much harder to find than people think it is, because the sum total of it in the marketplace is a negative given the fees of trading.
Thank you. Our next question These systems level investments getting practiced in emerging markets?
We would like to extend the studies to places like South Africa. The South Africa National Pension Fund is an example of a fund that is very concerned about overall ESG issues, empowerment issues, and economic growth issues, and to markets such as South and Southeast Asia. At the moment, we're just beginning our studies in that area, though.
Yeah, and just to add to that, two kind of key focus groups that we didn't get to cover as deeply as we had wanted to include central banks. So we've been following the work of Nick Robbins at the UNEP, and has been doing some really interesting stuff around the kind of way that central banks focus on systems level considerations, and that's in the context of different developing markets. The other is we did focus on OPIC and I think one or two other development investment banks that we would like to, obviously there a lot of the investments they're making are in emerging markets, and we also have designs to broaden our consideration of that particular actor going forward. So the short answer is yes, but that we need to better explore it.
Thank you. Our next question. The nonprofit space has historically generated a lot of interest in the topic of impact investing, but seems to be behind its international pension peers in actual investments. What would it take for nonprofits to be more let me just read. I just move the question one second. What would it take for nonprofits to be more successful and more inclusive of ESG or impact factors in their portfolios?
Could we get clarification on what kind, like, are you talking about endowments, nonprofits, or international nonprofit organizations?
Let me type a question to the person who asked that, see if they would get a response. And then
in the meantime, maybe we can go on to another.
Move to another question, and I'll come back to that one. Does ESG-driven investment have any premium for investors?
Let me answer that. There have been innumerable studies, and whatever you like the answer to be, I could find you a study that says it. Having said that, again, premium implies versus a market beta. Since systems level investing is designed to change the beta of the market, it's a question that only applies if you think that the beta is fixed. The question that was asked before about are you leaving alpha on the table sort of gets to this. If you are moving the beta of the market upward, then by definition you're improving your return, but you're not going to see it relative to other people because other people will benefit as well. Similarly, if you're decreasing the risk, other people will benefit. In terms of traditional ESG integration, and I should say that IRC Institute will have a paper about the taxonomy of how people integrate ESG coming out first quarter in 2017, end of house ad. The most recent studies that I've seen suggest that ESG factors do, on a relative basis, manage to give you a likelihood of outperforming relative to entities which don't consider ESG. However, that my belief is that window for outperformance will close very quickly because the most recent CFA survey says that 75% of the CFAs in the world consider ESG factors. So it's sort of when does alpha become beta? If 100% of all investors start considering it, it becomes the beta of the marketplace. And that's why the traditional MPT theory is limited in dealing with these issues, because MPT, ironically, is a really great theory if only a certain number of the marketplace pays attention to it. If everyone does it, then alpha becomes beta. If everyone affects systems, then the beta improves, everyone improves, and it's not a relative improvement, it's an absolute improvement.
Thank you. The next question, a great report, taking your 6 tools, the 2 which arguably have the best likelihood of dealing with serious and urgent risk, namely stewardship and universal investing, they have the least support. What do you make of this?
Yeah, so a couple of variables factor into that. I mean, one is just lack of familiarity with the concepts. So something like universal ownership is it's typically something that really major institutional investors, so like public pension funds or sovereign wealth funds, are really the only ones that are practicing it, or at least identify that way. So that's part of the dilemma. And then I think there's the level of just selection bias in terms of who we looked at in the study. So we tend to we did a bit of hyper network sampling, so looking at folks that had distinguished themselves in really interesting ways in the space and that stood out for particular reasons. But it certainly wasn't. We didn't boil the ocean. So this is a sample of 50. Chances are there's quite a few more in some of these other areas. And then I'm going to pause there because, Steve, you probably have a better response to, particularly with universal ownership.
Yeah, well, let me actually comment briefly on stewardship, which is an increasingly noticed concept among large institutional investors, including the ICGN, which recently issued guidelines. It's guidelines for investors on stewardships, and those guidelines specifically call attention to the role of ESG, and even within the role of ESG, specifically call attention to the role of systemic risk and the management of systemic risk as part of stewardship. Also, although the number of investors there in this particular sample focusing on stewardship may be small, we did not look at one of the largest investors which has adopted stewardship as a key theme, which is the Japanese National Pension Fund, the government pension investment fund, a $1 trillion fund, which has issued a general guideline to its managers. All of its assets are managed externally, that they need to adopt stewardship as a theme. So I think all these are vocabulary in which institutional investors are leading their way, feeling their way toward how to get up to the systems level. And while I think some of the vocabulary is going to be emerge as more popular than others, I think it's all these are all different avenues to the same end.
And if I could just add, as Steve sort of implied, those are absolute numbers. They're not capitalization-weighted numbers. So, for instance, BlackRock makes stewardship one of its calling cards. It has the largest engagement team in the world. It's also the largest investor in the world. So it's got $4 trillion behind that strategy or that tool. So I think that if as Steve said, they're all tools in the toolbox. Some are better suited for large investors, some are better suited for small investors. And I actually think that stewardship skews a bit for the cost reasons that we talked about earlier towards large investors, because they can amortize the cost of a really professional stewardship team over a larger pool of assets.
Thank you. We did not get more clarification on that nonprofit question, but if the person who asked the question is still on the webinar, we'll be sure to follow up with you right after the webinar via email to follow up on your question. We have one more question that I can answer. Will a recording of this session be available? And the answer is yes. We will have that posted by tomorrow on the IRRC Institute's homepage, www.ircinstitute.org, and it also will be on the Institute's YouTube channel. It looks like we are have gone through our full list of questions. So with that, we would like to thank all of you for your participation in the webinar today. Again, the webinar will be reposted, as will the PowerPoint presentation. And if you have any follow-up questions, please don't hesitate to reach out to us, and we'd be happy to have further discussions about the report. Thanks, everyone, and have a nice afternoon. Thank you.